In this video, we are going to learn how to do a bank reconciliation, where I will walk you through the steps needed to complete one. We will review when a bank reconciliation is done, why it's done, and how it is done, including the journal entries which need to be done to balance the cash account on the company books. Before we begin, we need to know the answers to why we do a bank reconciliation and when we do it. Bank reconciliations are done on the last day of the month when we receive our bank statement. There are two reasons why it is done. The first are errors, to ensure that there are no errors on the bank statement or in the company books. The second one is timing differences. We need to calculate the amount of cash we have after all of the outstanding items are cleared. We need to update our books for items not yet recorded in our books, but need to be. These are called timing differences. Timing differences exist because of three factors. The first factor is checks. The company records the checks in the company books as soon as it is written. The bank does not process the check until the person we wrote the check to receives the check and then cashes the check at their bank. The bank may not be able to process it because of the time differences between the customer receiving it and then cashing it. This can be days or even weeks. This is called outstanding checks. This is where the company knows about the check because they wrote it, but the bank doesn't know about the check until it is cashed. The second timing difference is bank deposits. The company receives the check in their office, and they will record it in their books as being received into their cash general ledger. When a company brings the check into the bank to deposit it, they may be doing it after hours or on a weekend when the bank is not open. The bank won't get around to processing the deposit until the next business day. This could be one day or it could be a couple of days depending on when the company makes the deposit. There is a timing difference between when we, the company, records the check and when the bank records it in our bank account. This is called a deposit in transit. The third reason for timing difference is new items. These are items we do not know about until the end of the month. Some examples include an EFT. An EFT is an electronic funds transfer. Someone, perhaps a customer, has transferred money into our bank account and we do not know about it. We may only learn about it when the bank statement arrives at the end of the month. This is not an error, we're just learning about it. Interest that is deposited into our account by the bank. This is called interest revenue or interest income. This increases our balance in the cash ledger. Or we can have interest that is taken out of our bank account because we have a loan with the bank, and this is called interest expense, and this will decrease our cash ledger balance. A bank service charge is where the bank takes money out of our account once per month. We will not learn about this until we get the bank statement because the bank fees may be based on the number of checks we have written or the number of deposits made. If you go over your plan, you're charged more for this. A bank service charge causes the balance in the cash ledger to decrease. So let's start walking through the steps to do a bank reconciliation. Step 1 is to identify what report is the bank statement and what report is the company's. This may sound silly, but a common mistake on tests is that students mix up the bank statement and the company books. So a hint is to write the names on the report so that there is no confusion. Notice that the company has at least 2 reports and the bank is only one statement. The first report, called the bank reconciliation, is from the month before. We will only look at the bank side of this report because there are items that the bank didn't know about last month, and we need to check to see if they received any missing deposits or outstanding checks that weren't on last month's bank statement. On the next couple of slides, we will review how to read a bank statement and how to read a company cash general ledger. On the bank statement, you may want to identify by using arrows what columns on this table increase the bank account or decrease the bank account. Checks, charges, debits decrease the bank account, while deposits and credits increase the bank account. On the cash general ledger, you may want to identify by using arrows what columns on this table increase or decrease the cash general ledger. Debit means the cash account is increasing, while a credit means the cash account is decreasing. So in step 3, we're going to check off or cross off all of the matching transactions. And what I mean by this is to find all of the transactions that are the same on the bank statement and the company's cash general ledger or the previous month's bank reconciliation. we can assume that since the transaction is on both the bank statement and the cash general ledger or the previous month's bank reconciliation, it is correct to cross off because they are the same. So let's go ahead and do this. So I'm going to start from the previous month's bank reconciliation. I'm going to check to see if that deposit cleared the bank. And I see that it has, so I'm going to cross it off the bank reconciliation, and I'm going to cross it off the bank statement. The next thing I'm going to go to are these checks. I'm going to go find check number 14, and I see that it has cleared the bank, so I'm going to cross it off the bank reconciliation from the month before. I'm going to look for check number 18, and I find check number 18 for $220, and I'm going to cross that off. And then I'm going to look for check number 20, and check number 20 has also cleared the bank, so I'm going to cross that off. The next thing I'm going to do is I'm going to go and take a look at all of these deposits to see whether or not they cleared the bank. And here's a deposit for $500, so I'm going to cross it off the cash general ledger as well as the bank statement. Here's a deposit of $1,200. It's on both the bank statement as well as the cash general ledger. Cross it off. But you see, this deposit is not on the bank statement, so I'm going to circle that because this is something that the bank doesn't know about. Now I'm going to go take a look at the checks. I see check number 23 for $375 is on both the cash general ledger as well as the bank statement. Check number 24 is not on the bank statement, so I'm going to circle that. That means the bank doesn't know about it. The person that we wrote the check to hasn't cashed the check yet. Check number 25 is also not on the bank statement, so I'm going to circle that. Check number 26 is not on the bank statement as well, so I'm going to circle that because the bank doesn't know about that. Check number 27 is on the bank statement, however, on the cash general ledger, it's for $103. And on the bank statement, it's $130. So there's a discrepancy there, and it's an error. So I'm going to have to figure that out. I'm going to put a star by that because I know it's on. That indicates to me it's on both reports, but I don't know which number is correct. And it does give me some additional notes, which we'll review in just a second. So we have, as I said, we have circled check number 27 because it appears on both reports, but the amount is incorrect. This transaction and the transactions which have not been crossed off are called reconciling items, and we'll deal with those on the actual bank reconciliation. The next step is to set up your template. It will be set up the same way every time. You start by entering in the company balance and the bank balance from the cash general ledger and bank statement, respectively. Then items which are either added on the company side or the bank side, and then deduct anything that needs to be deducted on either side. The adjusted balance, bank balance, and the adjusted company book balance must be the same. So on the bank reconciliation form, you're going to enter the company name, the name of the report, and the date at the top of the report. Then you enter the bank balance from the bank statement on the bank side and the cash balance from the cash ledger on the company side. We can see that the balance on May 31st is not the same. That is okay because of potential errors and timing differences, which we are going to resolve. The next step is to correct the errors. In real life, when you prepare a bank reconciliation, you would have to investigate and figure out how these mistakes happened. However, these questions and questions in your textbook are made up, and there should be additional information, which is found right here. This will help you figure out the mistake. In this example, under additional notes, it has been noted that check number 27 for telephone expense was recorded correctly on the bank statement for $130. It was recorded incorrectly in the company books as $103. How you deal with errors is that you reverse them where they occurred. In this case, the company took too little out of their cash general ledger balance to pay the telephone expense. The amount of the bill was $130, not $103. They wrote the check for the correct amount. However, they recorded it in their books for the wrong amount. So in this case, we must deduct the difference, $130 minus $103, which is equal to $27. And we must deduct it from the company side. and we record it as an error, check number 27 for telephone expense, recorded as $103, should be $130. The difference is 27. This causes our cash to go down and the telephone expense to increase. Now we need to adjust for timing differences on the company side using the bank statement. Any items that have not been checked off are timing differences. So let's begin. Whatever is on the bank statement that is not on the general ledger, we move it to the company side of the bank reconciliation. For example, the bank recorded interest on the deposits or credit side of the bank reconciliation, but the company does not have this entry. This increased our bank account, so we'll increase our cash general ledger. So we record it under the add heading on the company side because we did not know about it. Next, we record the EFT, the electronic funds transfer from Penelope Atwood. This information is found under additional notes. She is a customer who has paid her account. We record this under add on the company side as we did not know that she made this payment at the bank. This increases the cash account on the company side. On May 10th, on the bank statement, they recorded an NSF check from Zach Patterson, a customer. NSF means not sufficient funds. Zach's check was worthless. The bank decreased our bank account. However, we as the company had no idea that this had occurred. So we need to decrease our company cash account, so we record that under deduct. On May 31st, the bank recorded a service charge of $75. As discussed earlier, we don't know about the bank service charges until we receive the bank statement. Because this too decreased our bank account, we must decrease our cash general ledger account. In addition, on May 31st, the bank charged us interest expense for a loan that we have with them. This decreased the bank account. Now we must decrease our cash general ledger account on the company side. We have recorded all items that need to be reconciled off the bank statement. Now we need to look at the company cash general ledger to see if there are any items that the bank does not know about, but the company knows about. When we take a look at the company cash general ledger, we can see that there are checks that have not been crossed off. These are checks that the bank does not know about and are called outstanding checks. They are recorded on the cash general ledger, but not the bank statement. So since the checks are recorded as a credit on the cash general ledger, that means that they reduced our cash general ledger balance, so we must record it under deduct on the bank side of the bank reconciliation to reduce the bank balance. There is one deposit that appears on the cash general ledger account in the amount of $4,500, but it does not appear on the bank statement. This was probably deposited after the banking hours by the company, and the bank doesn't know about it. Since the deposit increases the cash general ledger account because it is debited, then we must add it on the bank side of the bank reconciliation to cause the bank balance to increase as well. This deposit should appear on the next bank statement at the end of June. The last step in doing a bank reconciliation is to find the adjusted balances on both sides, the bank and the company. We start by taking the starting balance of each and add and deduct the items recorded on each side. The adjusted bank balance on each side must be the same. If it is not, you will need to go back to your reports and see if you recorded everything or check for any other errors where you may have transposed numbers incorrectly when recorded it on the bank reconciliation, or you may have missed other errors when comparing the reports. The last thing that we need to do in the general journal is to record the journal entries for the items found only on the company side of the bank reconciliation. The reconciling items on the company side are items which have been recorded on the bank side, but not the company side. In order for the cash ledger to be $10,415, the adjusted company book balance, we must make journal entries for each item. Anything that is under the add on the company side, the cash will be a debit. Anything under deduct, cash will be a credit. To record the first entry, we would debit cash for $35 and credit interest revenue for $35. Since the electronics funds transfer belonged to a customer, Penelope Atwood, we would debit cash for $2,000 and credit accounts receivable for $2,000 because she no longer owes us money. The NSF belonged to Zach Anderson. Since his check isn't any good and he still owes us money, we would debit accounts receivable for $625 and credit cash for $625. The bank service charge is an expense to the company, so it would be debited for $75 because it is increasing our expense account, and we would credit cash for $75. The same thing applies to the interest in this case. It is an expense because we have a loan with the bank and they have charged us interest.